Okay, welcome back. We are on page 2 in chapter 8, and we are in part B. So we're looking at inventory valuation methods, which you have learned already. You probably just need to bring it back. Intro was quite a while. So you are responsible for knowing specific ID, FIFO, and moving weighted average or weighted average for periodic and perpetual for your exams. You have to review specifically in the text yourself, okay? Now, just to remind you, specific ID is used on large, usually costly, unique items cars. Can you tell one, I don't know the name of the car. I drive an old Yaris, so one blue Yaris from another one? Yeah, what's the identifier? The VIN, right? So that makes it unique. How about large pieces of art? Can you tell the difference? Yes. Those ones use ID. So we're talking about, here we've got an inventory T account with all kinds of cars in it, okay, that are sitting on your lot. So when you sell one, we don't have to use a flow, assume a flow, like FIFO or weighting at average. We can go, oh, well, here's the VIN, here's exactly what it cost us, that's specific ID. So what we're doing with inventory valuation methods, in case you don't remember, is we've got all this inventory. It's just chock full with a bunch of cars, okay? When you sell it, you've got a cost of goods sold and credit inventory, right? But which one do you pick? If it's cars, it's easy. You can identify, oh, it's this one right here, that's the VIN number, and that's the cost. Okay? And always remember, in this little inventory T account is always cost. So not selling price. Okay? That's what we're using these valuation methods to find out. So cars are easy. Large pieces of art, large pieces of jewelry, things like that. You can do that, pick exactly which one it is, and that's specific ID. So it's easy to do because each one is identifiable. FIFO and weighted average, moving and not. They're assumptions. For example, think of milk or dairy products in a store, okay? What do they hope? How do they hope you remove the milk from the, what are they called? You know, the store, the shelves. Well, they want you to move first in, first out, right? The oldest first, so you're always taking the older stuff, leaving the newer stuff for the next day and then the next customer. So milk would be an example of first in, first out. Then there's moving weighted average or weighted average. I'll talk about periodic and perpetual when we get examples. Well, let's say you run a hardware store and there you have a big bucket of nails. Can you identify which exact one you're selling? No, someone buys so many of them, puts them in a bag. So this idea is you kind of take an average of all the costs and mix them together. Okay? FIFO would say, oh, we sold this one first, then this one, then this one. Okay? Is this kind of coming back to you? Okay. So what you want to do is choose the inventory method which best reflects the physical flow or reflects the most recent cost in inventory. Use the same method for all inventory assets with the same character. Okay? So you do specific ID on your own because it's straightforward and it's very easy. FIFO, moving weighted average or weighted average, we're going to take these and make assumptions. we're going to just assume all the dairy products and the and everything in our grocery store, first in was first sold. We've got a bunch of stuff that's mixed together in a hardware store. We're going to assume it's all kind of clumped together and take a weighted average of all the inventory that's in at the same time. Because we are not going to go and identify, so we can tell exactly what it cost. Okay? Ultimately, specific ID would be the absolute correct way to do it. But remember, way back in chapter 2, we talked about the cost-benefit analysis, right? Identifying every single nail with a little barcode, so we know exactly what it cost. Is that going to give us more useful information than the cost it's taking to put on all the loads and then record them? Well, probably not. So that's why we are okay with these systems evaluation. So let me stop talking and let's get right to the examples so that you can remember them. Okay. So Pronghorn is a multi-product firm. Here's one of its products, the Trinton. Sounds like it's electronics. So here's what's happened. One thing, sometimes they don't put these in order. So these are in order, so we're happy, of time. Be careful, and sometimes they group all the beginning inventory and the purchases separate and they put the sales down here. So then you have to make sure you do it in order of time, okay, for some of the questions. Okay. So you notice here it's got price and cost. Beginning inventory, this is at cost. When we purchase it, that's cost. But sale is the selling price. Again, a purchase will be at cost, and sale will be at selling price. So these two are selling price, so they won't go in inventory account or calculation. So careful with that. You all the cost. You calculate inventory using cost. Okay. So here's the amounts they had to start, then they bought some, they sold some, they bought some, they sold some. It's nice in order and it tells you the cost and the selling price. Don't get them mixed up in your calculation. So on page 3, it tells us what we have to do. So keep this little page handy because that's got all your information. Oh, I reprinted it, so you don't need to keep it handy. Okay. So you can either have a periodic system where you update your inventory count only at period end. As you can imagine, before computers, a lot of things were periodic. So these are types of inventory systems. And then there's perpetual. Update inventory count with every purchase and sale. Remember, sale is at cost in the inventory account. So 2 ones we're going to do. And I want you to calculate for all of these cost of goods sold and ending inventory. Now this one's periodic and FIFO, then periodic and weighted average cost. Then we're going to do perpetual and FIFO, perpetual and moving weighted average cost. Okay? So let's start with the periodic. So parts A and B, we don't calculate cost of goods sold until period end. Therefore, all calculations for the 2 methods are done at the end of the period, not as you go along. Okay? So Well, let's put together our calculations. So we are looking for cost of goods sold, ending inventory, what we have at the end of the period. FIFO, first in, first out. Now, we used to use LIFO in Canada, but that went away both because the US can't use it for tax purposes, and IFRS just kind of cemented that. Okay, so let's do some calculations here. We need to know what we have available for sale, okay? So we are looking first for cost of goods available for sale in the year. Okay, so this is like a whole year. So we're looking at cost. So 1,500 times 11 is 16,500. We purchased 2,330 for $20 each, and that's 46.6. Then we mail. We don't care. We want to know what's available for sale. So just think of your little store and go, how much was all in here at once? How much was available that we could have sold? And we made another purchase at 21 for 68,400. So cost of goods available for sale is everything we had for sale. So 16,500, the beginning inventory, plus we bought stuff on February 4th, plus April we purchased 68,400, and that works out to 131,560. So that's all the goods we could have sold. And if we want it in units available for sale, these are all the different things they can ask or that you might need to calculate. Well, we had 1,500, bought 2,330, and we bought 3,260. So that's 7,090 units. Okay, now I want to know how many units did we sell. Units sold. Well, we sold 2,750 and 2,900, which is 5,650 units sold. So we have all this work done so that we can kind of see where we are and to reintroduce you to some of the terms that you might not have used for a while. So now we're going to calculate. And we want you to calculate cost of goods sold during the year and ending inventory. So cost of goods sold, we're using FIFO. So which ones got sold? These old ones or the new ones? Well, first in, first out, so the old ones. Old sold first. Okay, so we know we sold 5,650. So we have to take all the old 5,650 and get rid of them at their cost. Okay, so what's the oldest level? 1,500. So 1,500, and remember we want it at cost. Has to be at cost. Cost of goods sold. Times 11 is 16,500. No, it was already calculated. Then we're trying to go all the way to 5,650. That's where we're trying to get to, units. So that's 1,500. Are we going to sell this whole layer, the February 4th layer? Well, 2,330 plus 1,500 is less than this, so yeah, we're going to sell it. 2330 times 20, and again it's at cost, is 46,600. Now, the next newest cost layer is this one, April 2nd. Are we going to sell all of these? Well, if we would add 3,000, 5,000, 60, we're over. Okay? So we need to fill in the blank. 5650 minus 1,500 minus 2330 gives us 1820. So we're going to sell 1820 of these $21 ones. And that works 38,220. So you add up, these are all dollars, and you get 101,320 is cost of goods sold. Okay, so we just took the old layers till we ran out of how many we. Now we have to do ending inventory. So EI, or ending inventory, well, if we assume we sold all the stuff that came in first, what's the stuff that's going to be left? The newest, right? So this will be newest stuff. So, how many units are left? Well, units for sale were 7090, and we sold 5650. Once we have 1440 remaining.